Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Direct Digital Holdings, and let me tell you, it's a bit like watching a stock price on a roller coaster. It has its ups and downs, and you never know where it will end. Get ready to find out if this company is heading for the peak or a plunge. We're looking at a report filed in April of 2025. This is a current report, also known as an 8K, which companies use to announce big news to investors. Think of it as a company shouting from the rooftops about something important. So what's Direct Digital Holdings shouting about? Well, it seems they've hit a snag with Nasdaq, the stock exchange they're listed on. Back in October of 2024, Nasdaq sent them a letter saying they weren't meeting the minimum requirements for stockholders' equity. Stockholders' equity is basically the value of the company if you subtracted all the debts from all the assets it owns. Nasdaq has rules about how much of that equity you need to have to stay listed on their exchange. Direct Digital Holdings came up with a plan to fix this, and Nasdaq gave them an extension. Think of it as extra time to get their act together. The company needed to complete its plan to show Nasdaq that they're meeting the equity requirements. Unfortunately, by April of 2025, they still hadn't managed to get their stockholders' equity up to the required level. Nasdaq sent them another letter saying they didn't meet the terms of the extension because the company didn't complete its capital raising initiative, which means that they were unable to raise enough money and show they were meeting the equity requirements. Nasdaq said they would suspend trading of Direct Digital Holdings stock and eventually remove it from the stock exchange. But Direct Digital Holdings isn't giving up yet. They plan to appeal this decision and ask for a hearing before a Nasdaq panel. It's like going to court to argue their case. By requesting a hearing, the company buys itself some time. Nasdaq will hold off on delisting the stock until the panel makes a decision. At the hearing, the company will present a new plan for how they're going to get back in good standing with Nasdaq and keep their stock listed. During this appeal process, Direct Digital Holdings stock will continue to trade on the Nasdaq Capital Market under the ticker symbol DRCT. So investors can still buy and sell the stock while this is all going on. However, the company warns there's no guarantee they'll win the appeal. There is no guarantee that the hearings panel will grant the company an extension of time to regain compliance, or that the company there's no guarantee they'll win the appeal. There is no guarantee that the hearings panel will grant the company an extension of time to regain compliance, or that the company will be able to regain compliance during any extension period. If they can't convince Nasdaq that they're on the right track, their stock will be delisted. This means the stock will no longer be traded on a major exchange, which can make it harder to buy and sell and can also hurt the stock price. Now let's take a look at something important in this report, forward-looking statements. Basically, these are statements where the company tries to predict the future, but they also include a warning that things might not go as planned. The company uses words like could, would, may, and expect to signal that these are just predictions, not guarantees. They're reminding investors that there are risks involved and the actual results could be very different from what they're saying. They're saying that the future is uncertain and there are many things that could cause their actual results to be different from what they expect. The company lists a bunch of reasons why things might not go well. One big one is their debt. They mention restrictions and agreements tied to their credit lines. If they can't meet the terms of these agreements, it could cause problems. They also admit there's substantial doubt about whether they can continue as a going concern. This is a serious warning sign. It means there's a real possibility the company might not be able to stay in business. This is because their ability to continue doing business relies on them securing additional financing, which, based on how they are saying it, might be a challenge. They are also currently ineligible to file some easier registration statements on Form S3, which may impair their ability to raise capital. Now, we're currently ineligible to file some easier registration statements on Form S3, which may impair their ability to raise capital. And of course, there's that whole Nasdaq delisting issue we just talked about. The fact that they might get kicked off the exchange is a major risk. It could make investors nervous and hurt their stock price. The company also points out that they depend on a small number of customers for a large part of their revenue. If they lose even one of those big customers, it could hurt their business. They also worry about getting paid by their clients. If clients don't pay on time or at all, it can create cash flow problems for the company. Another risk is advertising fraud. If they fail to spot fake or misleading ads, it could damage their reputation and hurt their business. They also highlight some technology-related risks. If their platform has problems or if they can't keep up with the latest technology, it could hurt their competitiveness. Changing rules about how companies can track users online could also make their platform less effective. The company also worries about negative publicity and public perception. If people don't trust their industry, especially when it comes to data privacy and security, it could hurt their business. If they don't manage their growth well, it could also create problems. They also mention the challenge of making new acquisitions and merging with them. Changes in laws and regulations related to data collection and processing could also impact them. They also face some challenges related to their clients that are destination marketing organizations. These organizations often operate as public-time partnerships, which can create unique challenges. Finally, they worry about data breaches. If they accidentally leak confidential information or if their computer systems are hacked, it could cause serious damage. As a holding company, they depend on distributions from Direct Digital Holdings LLC to pay taxes, expenses and dividends. The owners of DDH LLC may have interests different than the company's stockholders. If they don't maintain effective internal controls or if they fail to detect fraud, it could also hurt their business. Now, what's my take on Direct Digital Holdings? They're definitely facing some challenges. The Nasdaq delisting warning is a big red flag. It suggests they're struggling to maintain financial stability. The risk factors they list are also concerning. The debt, the dependence on a few key customers, and the potential for technology disruptions all point to vulnerabilities in their business model. There are also many external challenges that are difficult to estimate, but might be significant, such as changes in laws and regulations or a worsening public perception. On the other hand, they're fighting to stay listed on Nasdaq, which shows they're not giving up easily. If they can successfully appeal the delisting decision and come up with a solid plan to improve their financials, they might be able to turn things around. Ultimately, Direct Digital Holdings is a risky investment right now. There are too many uncertainties and red flags to ignore. The company's future depends on them successfully navigating these challenges and proving to investors that they can get back on track. I'd say approach with extreme caution. Thanks for watching Corporate Decoder. If you found this breakdown helpful, be sure to like, comment and subscribe for more insights into the world of corporate filings. Let me know in the comments what company you'd like me to decode next.